Welcome to another episode of the Chicks on the Right Show. We have our special guest, friend, and sponsor of the show, Zach Abraham from Bulwark Capital Management with us. And we live in interesting times, Zach, as I'm sure you know.
That's a good way to put it.
And today, there was this article on the Daily Mail about a fellow by the name of Mark Spitznagel, who is the president and CIO of Universa Investments. And he is like Mr. Doom and Gloom man in this article, saying that we should basically be all like holding on to our hats because there's going to be a crash. And I want to know your take about that.
Well, so Spitznagel is one of those guys that I don't think that you brush off. There's a lot of guys that talk a lot in this industry, and it's as much marketing or maybe even more marketing than it is substance. He is not traditionally one of those guys. So I definitely think he's someone to listen to. Look, and you know, this is something that we've been trying to talk to our clients about. And I think it's really hard for people to understand because, you know, markets keep going up and you know, greed or missing out on potential gains gets people to do a lot of stupid stuff. But the bottom line is that you have big swaths of this market and the parts of this market that have really driven the market. They're just really disconnected from any sense of risk or any sense of underlying fundamentals. They've got priced into them just complete optimism. Again, I've said over and over, it is not the same as 99, right? The difference being that I think a lot of what's driven this is you have really good companies that are just at valuations that don't make sense. So the companies are really good. There's no knock on them. But remember, at the end of the day, you get into these periods of times where a business pays you. If you invest in a business, you get paid by profit, right? And if you pay too much for that business, it takes you way too long to get your money back, right? Because investors, technically speaking, we don't begin making profit until our original investment is returned to us, right? Well,
Right.
when you approach that, when you use that kind of valuation method to look at some of these companies, there's just a disconnect there. It's just nobody would pay, you know, nobody would pay for a company that has a 0.6% earnings yield, meaning if I invest $100 into the company, my profit I'm getting off that per year is 60 cents, right? When a company is growing at 25% a year or 30% a year, that's a really good growth rate. Okay, but you do the math real quick. And if I'm buying it at a 0.6% earnings yield, that growth rate better keep up for a really long time because I need it to in order for it to make any sense, right? So when you look at it from what Mark Spitznagel's talking about, the length of this run, look at debt levels, you look at all these different things, I agree with him. At the same time, you know, and it will culminate in a crash at some point. Right now, though, my anticipation would be that it's going to get crazier before we see that crash. And at the end of the day, you've just got this dynamic going on where when you have all this money printing going on, when you're running deficits that are 6.5% to 7% the entire size of the economy, that money has to go somewhere.
Yeah. So like,
right.
All right. So then like Mock is buying a house and there's all sorts of stuff. I mean, interest rates, like, cause there's, I call them the people with the big heads that get together and they sit at a table and they decide that. So what do you think interest rates are going to do in September?
So I think that you can just bet your bottom dollar at the very least. I will be shocked if you don't see a cut of 25 basis points.
They're going to cut? Okay.
Yeah, they're going to cut for sure.
Only 25 basis points?
Probably. That'd be my guess, 25 to 50. I would say the odds are at 25. Because remember, that you still have, like, you see areas of weakness, but all of the areas like unemployment, retail sales, all of the stuff that's really supposed to be, you know, probably the most important inputs for these interest rate decisions, those things are not really in a position where traditionally you would be waving a flag going, oh, we got to cut rates, right? That being said, the longer we're at these higher interest rates, you know, the more bad things I would anticipate popping up. So the way you look at this, though, is it's really easy. I think people put a lot of ambiguity around interest rates. Markets have all this stuff priced, right? So what you can do is you can look into the interest rate futures markets, okay, which are looking at interest rates out. And right now, those markets are pricing a 32 basis point hike or cut, in September. Okay, so that's why we're saying basically the market is saying odds are 25, could be 50, right? That's why it's at 31 or 32 basis points. Only one time in the last 25 years has the Fed made an interest rate decision that wasn't told to us ahead of time in the futures markets. Okay,
Really?
so once in the last 25 years. So when you go into Fed Day, whatever is priced in the futures markets, you've got about a 96 to 97% chance, and that's a real number, 96 to 97% chance that that's going to be what the decision is. So I would say, there's a lot of ambiguity about it. Are they going to cut? Are they going to raise? They're not raising. They are going to cut. The question is 25 to 50 basis points. I think you got a 90% chance that it's 25 basis points.
So that Spitznagel guy, which I just love his name.
Yeah,
I
he's
know.
a sharp guy too.
Not to be confused with Mark Spitz.
Yes,
right. Totally different Mark Spitz.
Different Mark. Yeah.
Right.
But part of that article was him saying that the reason that he's predicting this giant crash is because of the Fed's like how long they've kept interest rates so high. Do you think that's true? Like, should they have already lowered them? Are they too late? I mean, is it going to do anything? Is it going to matter?
This is such a complicated conversation because if you put me in the Fed's seat right now, so if I took Jerome Powell's chair right now, looking at what he's looking at, I would cut by 25 basis points. Okay. But that being said, we should never have been here, right? They should have raised way quicker, way earlier. It would have allowed them probably to raise less. But here's the other side of it. We shouldn't have been at 0% interest rates for 12 or 13 bloody years to begin with.
It was zero.
It was zero. It was. Yeah. So the Fed fund.
Oh, okay. Yeah. Because I see what you're saying, because like bank interest rates were like nothing.
Right. So the Fed funds rate, which is, think about that. The Fed funds rate, if the economy is the house, the Fed funds rate's the foundation, right? So that's the base interest rate that impacts everything else. Well, that is the rate that we were at coming out. I think we went to zero in 08. Toward the end of 08, we came out of zero for a couple months in 2018. We went right back to zero, or 25 basis points, effectively zero. So, if you look at it, what are we at? Like 12 of the last 14 years, you've been at 0% rates. So that to me was the big anomaly. That was the big, and one of the reasons you say that is because you knew, look, at some point when inflation shows up, you're probably going to have to hike higher than you should and faster than you should. And that's certainly what's happened. But here's the thing, and I agree with guys like Spitznagel, but I think that we have to throw something else in here. Look at what happened last year. Okay, so everybody's just whistling past this. But last year, had the Fed not intervened with an additional $350 billion that they just printed out of thin air, the entire regional banking system would have collapsed. And I'm not being hyperbolic, because what happens? Were all of those banks insolvent? No. Were all of those banks as irresponsible as Silicon Valley Bank? No. But what happens when 2 or 3 banks collapse? Everybody else runs, right? Remember, It's a Wonderful Life, right? Everybody else runs to the bank, pulls their money out, and it's a bank run, right? You were in the early innings of an absolute national bank run on regional banks. So everybody's like, could higher interest rates damage things? And I'm like, you had to use artificial means and $350 billion worth of printed money. To put that in perspective, remember Occupy Wall Street?
Oh, yeah.
Right? We were throwing fits over the bailouts that happened in 08, 09. That was over $880 billion. Right? The Fed just threw $350 billion about it, and it barely made the nightly news last year. Right?
Wow.
So I look at a guy like Spitznagel and I go, I agree 100%. But as long as the problems that we are facing can be fixed with printed money, that's what they're going to do. And they've showed us that, right? At every turn, reality's starting to set in, and they're like, we'll print some more money. Right? So I don't see that coming to an end anytime soon. But what I would say, and this is what we're telling people, Look at where you're at right now. Go look at gold. Gold hits another all-time high today. We look at gold miner stocks this year. Everybody's so, focused on, all these other companies and tech. And look at the NASDAQ. NASDAQ's up 17, 18% on the year. Gold companies are up 28% on the year, right?
Wow.
So now look, that's not what it's telling people though. And what I do think is that this age of there's only 10 stocks that matter in the world and nothing else matters, that seems to be changing. The other side of it that we've been talking to you guys about and all the people on our webinars and everything is, hey, I'm not telling you we know exactly what's going to happen. But what you do need in this environment is for now anyway, the days of 0% rates are over. Inflation is here. Macroeconomic indicators are becoming a big thing. China's got some issues, right? Things matter again. And so you look at the average portfolio. You know how much the average retirement portfolio has exposed to those gold companies that are up almost 30% on the year? Zero.
Wow.
Right? Do you know how much, historically speaking, in a time of inflation, it would make sense to have more exposure to commodities and natural resources, right? So historically speaking, if you own the S&P 500, that would give you a 12 to 13% exposure to energy stocks. Today, it's about 3.5%, right? So you have maximum exposure to all the things that have worked and historically low exposure to all the things that are starting to. And the brilliant thing about those things that are starting to work, they're still ridiculously cheap, especially when you compare them to the rest of the market. So, I think I agree with Spitznagel. I see all the dangers, but I just look at it and I'm like, until there is an issue that doesn't get fixed with printed money, they're just going to keep going back to the well and printing money.
Well, so you mentioned your seminars. How can people join in on those reindeer games? Because those are super important.
Yes, I like that term, reindeer games. So you can go to bulwarkcapitalmanagement.com, knowyourriskradio.com, and sign up. We've got another one coming up. I want to say like at the end of this month or early next month. Anyway, free of charge. And basically what we show you is look at, okay, here's the market. Here's what the vast majority of all of your portfolios are based off of. Here's what the market looks normally like. Here's where it's at today. And you just see it for what it is, right? Because the reason people invest in the stock market is because it's automatic diversification. Except today, it's not today. It's just a giant tech fund. So it's a one-way bet. And you're betting on the most extended, the most expensive part of the market where we're looking out and going, there's phenomenal valuations to be had out there. The catch is just nobody owns that stuff.
Interesting. I love this. Yeah.
Well, thank you once again, Zach, for all the insight. And people should definitely check you out. KnowYourRiskRadio.com. Thank you.
Thanks,
Thank
Zach.
you, ladies. Fun as always.
Investment advisory services offered through Trek Financial LLC, an SEC-registered investment advisor. Information presented is for educational purposes only. It should not be considered specific investment advice, does not take into consideration your specific situation, and does not intend to make an offer or solicitation for the sale or purchase of any securities or investment strategies. Investments involve risk and are not guaranteed, and past performance is no guarantee of future results. For specific tax advice on strategy, consult with a qualified tax professional before implementing any strategy discussed herein.